Alright, welcome to another video, and welcome to part 2 of the market review for January 6, 2011. Let's go ahead and finish up reviewing the silver market. I feel, and this is just my personal viewpoint on it, I feel that the resistance on the silver market has already been broken, so the longer-term 7-year resistance channel has been broken, and right now we're sitting at around $20.05 on silver. Because of that, here's what I honestly think. We should be continue to be somewhat bearish, but I don't feel that silver will go below $24. I'm looking at as far as the correction is concerned, somewhere around 10 to 20%, something that will fit below the multi-year long channel, but will be reasonable enough and not so fear-driven that it's unrealistic. Because investors are only willing to sell, or traders are only willing to sell up to a certain point before bargain hunters just want to step in, start buying these commodities at a cheaper price, etc., etc., etc. So pretty much, I'm looking at around $27. It could continue going lower than that, but the likelihood is small that the dollar would suddenly appreciate by 20%. The worst or the best case scenario is a dollar-fueled rally that goes up by around 3 to 4%, on top of fearful bulls starting to sell all at once. That will probably create a minor correction of around 10 to 20%. Because of that, if you combine all factors, somewhere around 27 would be a reasonable support level. It has been shown to be a great support level before. If that level is broken, we should most likely be able to find some value investors willing to plug into this market at around $25 per share. And if you have a really weird looking tail, something like this, it could happen from $25 on down to $24. But the likelihood of it, yet again, of it staying below 24, 25, or 27 is relatively slim. But we should see these as the main support levels in the coming weeks and months ahead. Let's go ahead and review the crude oil market. Crude oil market, same thing. It reacted very negatively to the overall dollar rally, and because of that, commodities aren't in play right now. You just can't buy into a commodity when the dollar is continuing to rally. How do you hedge against that? You could either go long the dollar, that's one way, either that, or you can short these commodities, that's another way, or either that, or you could just, there's so many things you could hedge against right now. There's so many ways you can make money off this market. Or you can have a flee for safety, buy safe stocks, buy safe bonds, and that's about it. Let's go ahead and see what crude oil has influenced. Let's go ahead and look at the next chart, which is going to be the oil company that I recommended just a day ago, which is BP. Alright, let's go ahead and look at the BP stock. First of all, the trade triangle technology indicated a stronger uptrend at around $44.20, which would have been excellent to get into at that point in time. However, right now is not a good time. Crude oil keeps going down in value, and if crude oil goes down in value, the oil companies should follow suit as well. So what basically was hot isn't really hot anymore, so I can't really recommend oil companies right now. Next stock that I was thinking would be good, but I changed my mind on that, would be AIG. AIG was attractive at first, but the only issue I have with it is this ugly looking inverse hammer. And when you have an ugly looking inverse hammer like that, it's not a time to be buying, it's actually a time to start selling into this type of market craze or action. Because of that, the most practical thing you could do is you could, if you want to hold on to AIG stock for the next 10 years, which wouldn't be a bad idea, all you would really need to do is buy some put options to protect your portfolio from this coming earnings-fueled sell-off. So because of that, my recommendation is either you sell the stock right now to protect your portfolio. If you want it for the longer term and you just want to hedge the portfolio, you start buying some put options to protect your portfolio. And one put option should cover 100 shares. And I'm not saying that you should start speculating or anything, but if you absolutely want to, that's totally up to you. But as far as hedging is concerned, that is how you should do it. Protect your portfolio, and you don't really need a super long-term contract, because when markets pull back, they pull back in a relatively fast manner. So that it would only take like 2 weeks for a market pullback to complete itself. And because of that, you don't need to buy a whole lot of time on any type of put contract. In fact, you should only buy up to 2 months worth in time. No, not much. You don't really need much more time than that. And if you want to buy more time, that just costs more money, and it undermines the purpose of protecting your portfolio with the least amount of premium necessary. Let's go ahead and review the bond market. The bond market is also having some sort of rally because right now investors are having a flee to safety. What happened in the retail sector was that a lot of retail companies performed badly. They didn't necessarily perform badly, but they didn't perform enough to satisfy investors, which doesn't ever happen anyway. But pretty much what happens here is that these investors that were disappointed from the earnings company from various S&P 500 component stocks are finding refuge inside the bond market right now, and that should continue as earnings season progresses. And that's kind of what I was trying to bring out in my previous post, or my previous videos, that companies aren't going to perform miracles. Investors are going to be disappointed this time around, and it's always been that way. It's always going to be that way, except for some few rare case scenarios. But these days, it's always about companies not being good enough, and because of that, there's going to be this earnings-fueled sell-off. And because of this earning-fueled sell-off, these bond investors are going to pull out, or these stock investors are going to pull out and have a flee for safety. Let's go ahead and review the next stock, which is the Bank of America. Bank of America is another interesting story. Same thing here. I mean, value stocks are very dangerous to go into right now. You're at the tail end of the market rally that's been going on for a couple months now. And because of that, I really can't say Bank of America is the safest place to be in right now. You could either buy some puts to protect or hedge your position, or you can just sell the stock and wait for a better time to go back into it if you've already been in it for a while, or if you've been in it for a really long time. Let's say you bought it back in 2008 or something. Well, then right now all you can do is wait and hold and buy some put options to protect this earnings-fueled sell-off that's going to be coming in pretty soon. And like I said earlier in my post, or earlier on in my video, to protect your portfolio, you don't need to buy so much time. All you need to do is buy like a couple months. But if you don't understand options trading, or if you don't understand the dynamics of stock options, then what you can do is you can buy the FAZ. And the FAZ is basically supposed to appreciate 3 times faster than whatever a stock may fall by, on top of a little extra more. If you want to see if you want to hear an explanation for that, let's say Bank of America falls by 5%. FAZ, in theory, from an efficient market standpoint, should appreciate by 15%, but generally it does a little more than that. Sometimes it gets to around 20 to 25%, and that's because of the shorts being squeezed. That's because bulls, just running in and just saying, hey, or more like bears. Let's be realistic. This is a bear fund, so bears getting excited and they just start buying into it. People who are short the fund get out of it because bulls in these type of funds tend to short these type of funds, because that's how you operate when the market goes up. Because if the markets go up, these type of stocks fall down. The best way to play it is to short it, because at least they'll consistently fall at a faster rate than whatever the market can go up by. That's what some people do. Because of that, when the markets start pulling back, they're going to start covering the shorts. That should push the market up very fast. They'll push through the bids, or they'll push through that'll push the bids up exponentially. That will cause the asks to constantly basically continue to keep on going up and up and up, just to try and get out of the markets, or trying to get out of the FAZ market for that matter. Because of that, that should push it up an extra 5, maybe an extra 7% on top of a 3 times move in that same direction. So that gives you a basic idea. If you want to hedge your position, you can start buying into some FAZ and start selling your banking stocks, make some quick money off this pullback, and then make a re-entry back into your banking stocks. If you're a short-term trader, longer term, you would probably just buy FAZ and use it as a short-term scapegoat, as a way to lick your wounds and make sure that you're not damaged as much from this earnings-fueled pullback. And the next thing you could do is you could just buy put options, like I was mentioning earlier. Let's go ahead and review AMD. AMD is the same thing. And the AMD, basically technology companies are doing pretty bad right now. I don't really recommend them. This company has 2 beta. Pretty much if the stock market were to go up by around 10%, this is the type of company that would go up by 20%. If the stock market were to pull back by 10%, this is the type of company that would pull back by 20% or even more. And because of that, just because of that, I mean, I mean, back in October, this company was trading at $6.80. That was pretty much a 40% pullback off of like $9 or 30% pullback, even though the stock market only pulled back by around 5 to 7%. Because of that historical reading or that historical pattern of it doing much worse than what the general markets do, you should either sell this stock, buy some put options in the stock, and if you're just a flat-out speculator, I mean, you don't care about hedging, you just want to make money, then yeah, you buy some put options. Or if you're a longer-term investor, you'd probably say, hey, I had a good rally in this, I made some money off this, I'm going to check my portfolio, start buying bonds, start buying safer stocks. Fine, you can do that as well. Let's go ahead and look at the next chart, and after that, that's all we're going to have for today. Alright, the next chart is volatility index. So let's say you just want to hedge your portfolio overall to the volatility that would come from a market pullback. Because what happens in the volatility index is that it goes up if the stock market goes down. And if you don't have access to shorting the stock market, you don't have access to put options, and you don't have access to the bond markets. Let's say you have no clue how to buy a 10-year treasury or something. Fine. The next thing you can just do is just buy into the volatility index once the markets actually start pulling back. And I'm going to point that out in my market review videos later on when that actually happens. You're going to see it's going to be obvious. You're going to see it. You're going to see a break below a major trend line. That in turn is going to cause the Dow Jones Industrial to start pulling back by 3 to 4%, maybe 2% in a single day or 1.5% in a single day. But you're going to be able to tell. And once you're able to see a clear picture of it, the next way you can hedge your position is via the volatility index. For those retail investors who have already gotten slapped hard, you're going to get slapped harder once this earnings fueled season is done. People start selling all their stocks out of their portfolio and start anticipating a bargain rally later on between Q1 of 2011 and Q2 of 2011. That's when we should start looking for buy entries after Q1 2011. Somewhere in the middle after Q4 2010 earnings have already been released. And without any further ado, that's going to be all for today. Please be sure to check out my videos in the near future. I know that today's series of videos were a little long, but I had a lot of stocks I wanted to cover. I wanted to go over a lot of economics, a lot of what you can do to protect your portfolio, and I hope that I've been able to accomplish that within this video. And because of that, I feel pretty satisfied with myself, but more importantly, I just hope that it reaches your ears and it helps you realize that there are so many things you can do, even with foreknowledge of a disaster. You don't have to be a victim of a disaster or a short-term pullback in the markets. And because of that, if you want better information or if you want some good charting data, I'd recommend you use the charting software that I use currently. Please be sure to check out the link above this video if you're on Facebook or below this video if you're on YouTube. That is all for today, and be sure to keep on checking out more of what I have to say in the future. See you later, guys. Bye.